Good afternoon and welcome to the latest in our I Am a Founder webinar series. During times of economic uncertainty, there is no question that boards and investors lean more than ever on the opinion of the CFO. Already more than half of the FTSE 100 CEOs have a finance background, a figure expected to grow in 2021 with the impact of COVID, particularly as investors and boards look at times almost on a daily basis for strategic financial insight, tighter financial control as they take more complex, wide-reaching decisions which impact investors, employees, customers, and the wider communities as a whole. It seems appropriate today that we look at how a venture CFO can help you achieve your business goals in your high growth business. My name is Adam Brody, and I'm the co-founder of Ignition Financial. I'm delighted to be joined today by Tom Connor and David Hornby, two very experienced CFOs, and I'm delighted to say colleagues of mine. This is a panel discussion, so we do welcome questions from you. So please do type any questions that you may have into the Q&A box, and we will do our best to bring them up into discussion as quickly as we can. By way of introductions, Tom, David, perhaps you could start off by introducing yourself and your experience.
Thank you, Adam. My name is David Hornby. I trained with KPMG over 30 years ago. So now well over 30 years experience covering numerous economic cycles from the difficult times in the early 1990s through the growth periods, and then at another potentially difficult period of time. I've got a lot of experience in a number of industries. In the last couple of years, I've focused a lot in people, businesses, technology, and property areas. Over the last 12 years or so, I've been an advisor and a CFO to a number of SMEs, and where I've been working with them scale up and go through the growth and funding, and then looking at succession and exit. I'm passionate about helping leadership teams navigate the challenges that they face. Tom, over to you, if I may.
Thank you, David. I'm of a similar vintage to David, PwC background, spent some time in the practice before moving out into various sectors and industries, from a range of pharmaceutical, automotive engineering, business information consultancy, FDiva Motor Group, then from there to Watersons as head of finance and then interim CFO, and also charitable sector as well, Thomson Reuters Foundation, 13 years as a CFO on the board of the Edinburgh International Book Festival, and the last 4 years working with Adam and Ignition Financial at supporting founders, scale-ups, early stage companies through all the various facets of the services that they require.
Perfect. And Tom, I think one notable omission is that that you and I share the honour of having been honorary treasurer of London Scottish. You were my predecessor and I was your successor.
Yes, indeed. Yes, indeed. I remember that handover very well.
Thank you very much. Right, perhaps we can kick off today. Look, we're going to, this is very conversational, so please do come in with your questions. We're going to, I think we'll kick off with the obvious question, and Tom, maybe I could start with you with, what do we mean by VCFO or Ventures CFO?
I think what we're talking about here for the purposes of our discussion is an experienced finance professional who's operated at board level and who can provide the support and advice for early stage companies who are not yet quite at the stage of requiring a full-time CFO. So there are various levels of engagement for a VCFO with an early stage company. That is often around raises, supporting investor relations, cash flow modeling and forecasting, and also supporting the financial modelers involved. And in that respect, when a VCFO comes on board with a young company, the VCFO thinks as an investor thinks.
Yep.
So they're already doing that external thinking for them and providing some objectivity into that process. And also, I think in that context, I often think of a CFO, well, one of the aspects of that role is as a risk navigator.
Yep.
Beyond that, through and beyond the raise, the VCFO can also provide help as a trusted and objective advisor for the founders and the board, talking about key strategic decisions, or else sometimes just wanting to chew the fat, as a sounding board. Because with a VCFO, what you're getting is you're getting the, if you like, the distillation of a long finance career at a much earlier stage than you otherwise would have. And, in that regard, the VCFO can also begin to bring experience as to the operational processes and reporting structures, by which I mean, not too much structure and process that it sort of, restricts the flexibility of a young company in a fast-moving environment, but enough that it supports the engine and critically helps the engine to grow. That's the key thing. And I think in that respect, I think of a VCFO and a CFO in an environment like that as the operational fixer within a company. And also investors, just to talk about them for a little bit, they're also quite often the founders are, highly entrepreneurial, young, striving, motivated professionals, and the investors are also looking around that environment for someone who's been round the block a few times, who, looks as if they can sort of weather the storm, can talk to that, also can talk the upside as well as talking how to minimize the downside. And so there's a credibility there that the CFO can bring to that environment.
So would we say it's certainly investors take comfort from having someone with some experience and some financial experience in that regard? Is it fair to say, I think, for investors, they are trying to price risk, and perhaps having some financial experience and some financial control, looking after their money, as it were, does help reduce risk in their eyes, or give them a bit more comfort?
Yes, I definitely think so. I mean, not quite the touch of the grey hair helps, but, well, that wouldn't be the case in my case, of course. But they want to have that assurance, if you like, to whatever degree, that an experienced financial professional has not only been through the numbers, but has had the conversations with the founders or the board, the CEO, about the processes which have produced those numbers. So the investors are very familiar with looking at all types of models, and they're looking to the VCFO for that same familiarity and experience with those numbers. So it's a sort of search for assurance, and therefore, to answer your question, Adam, it's mitigating the risk, because that's, they are trying to navigate their risk as well.
Tom, I'd just like to go and add in one thing on that I've certainly seen a number of instances where you're involved, and it's you've been around those blocks a few times, you've got a lot of experiences. Frequently, businesses are very enthusiastic, but there is a tendency for different types of businesses at times to make very similar mistakes. Being around those blocks helps reduce the extent of those mistakes, and it quickly either completely avoids them, or it means that the damage is much less than it could have been.
So in terms of timing of support, I mean, when we talk about a lot of the companies that we work with, you've got seed, you've got Series A, Series B, etc. And the Series A is when the venture capitalists come involved, so professional investors. Is it something to look at before investment? Is it something to look at after investment? Would would it make a difference to probability of closing an investment round, or perhaps even terms, if it's before or after?
I think it can depend on who the investors are.
Yeah.
And the size of the investment, as you say, at that sort of seeds and early stage angels, it may be a sort of connection of the founders or whatever. You know, they might have a look at the numbers, but they'll be looking at the plan. They might be looking at the quality of the individuals, etc. But at some point, as I've certainly found, at some point, the investor, particularly if they're going for an additional raise, it might not be huge, but just an extra pot of money, will say, right, can we have, you know, a qualified accountant or a CFO just run their eyes over this and make sure they're happy with it, you know, give it the once over, at least have a chat to you guys before coming to us. And then as obviously as the raise gets bigger, the input required is bigger.
I think that's right. I think from the clients that we work with, the pre-seed and seed stage, it's more about making sure that things are in order from the traditional accounting sense, so the management accounts are kept up to date for the year-to-date actual, all the compliance is in place, all the taxes are done. But it is when the business starts getting traction quite quickly, and there is the likelihood of going and raising from a venture capital firm, that actually getting some more strategic financial input, i.e. forward-looking, rather than what traditional accountancy practices do, which is looking backwards. That's where I think we tend to see most of our clients benefit from some support, and actually at perhaps the seed stage, it's more light touch. Would that be fair, David?
I think at this stage it's a lot lighter touch. It's just having that confidence about that underlying information, and particularly that look forward into the future.
Great. So should we move on to the things which should be keeping founders awake at night? So I think, David, there's 3 items here which you've come up with. Perhaps you could kick off with the management information, because I know a lot of the clients we work with are data driven in how they run their businesses and collect data. So perhaps this is a good point to start.
Thank you, Adam. We're going to talk very much here about appropriate management information. Before I go and talk about it, I'd just like to go and say the 3 areas I'd like to cover. So the benefits of appropriate MI, what do we mean by appropriate, and some common reasons why businesses don't at this point in time have appropriate MI. But before I cover it in those, I just want to step back and just imagine for a moment. It's a Tuesday morning, it's early. You're the CFO of a business. You're about to go to a really important meeting. It could be you're attending your board meeting. It could be an important pitch with your investors for further money. Or the other one is you're going to see your bank. You're going through performance. You've got your MI pack. You are there. You're about to step in the room. We all know how that feeling is. And it's your MI pack you're going to be discussing. What's the key thing that needs to come across from your pack? For me, it's your numbers are robust and you've got good, appropriate and fit for purpose MI. That's so important. If you don't have those issues, and if that's not covered, you're going to have a lot of pain. So really important to get this robust and get it appropriate. So let me just go and talk about the first of the 3 areas I wanted to mention, the benefits of robust management information. And I look at this at probably 2 levels. The first of all, you've got day-to-day basis, and then you've got the strategic, you've got an event-driven scenario. So on a day-to-day basis, what you're wanting here is information that enables you to make faster, better, it's data-driven decisions. So its decisions are made from facts. The second, when we're coming to the transaction, is if you've got good MI, it's going to help you through the transaction. It's going to go and help that execution risk. We've all heard stories about MI and the information flow to the due diligence accounting is just taking an inordinate amount of time. The longer that goes on, the more execution risk there is, the more risk is that problems will be found, and you're probably increasing the risk of someone wanting a price chip. So it's really, really important to get your MI right. So what do we think good management information should contain? Clearly, this is a large topic. We're not going to go into the detail, but what you might and typically expect in a modern board pack is the dashboards, the KPIs, something that gives you a real feel of how the business is performing. Commentary, yes, make sure it's there, but it shouldn't be too lengthy. A lot of exception reporting, traffic lighting, RAGs, just really highlighting areas. What should the pack include? Well, it should naturally include your P&L, the balance sheet, and your cash flow. It should be backward looking for the current month, the year to date, and it also should have forecasts, certainly for the remainder of the year and 1 or 2 years into the future, very much dependent on the business.
Quick question for you, David. I agree with that list very definitely. The one which jumps out to me is KPIs, because you see some management information or some board reports, and the KPIs run to dozens and dozens and dozens. How many? I mean, and so almost ignoring the K part of
it's P&I, isn't it?
So how many would you suggest, or would you typically see in a good MI pack here, or how would you see those KPIs perhaps?
I think you're anywhere between 5 and 10, depending where you are on the evolution of a business.
Okay.
I think if you've got less than 5, you've not got enough. You're focused on very critical KPIs, and as you say, if you've got more than 10, that they're not Ks.
Yeah. Okay.
In your MI pack, you want some reference points, and so I would say you need last year, budget. If you're in the habit of reforecasting, the forecast, and any investor colleagues here always like the reference point to their investment plan. Depending how tight you are on cash, a lot of boards like to see a detailed 13-week cash flow.
Yeah. Sorry.
Tom, you're going to go and cover cash shortly. So a lot of businesses, I think it's really important to have it. And then the other area is having growth trends, trying to have a lot of graphics, have a report that's easy to assimilate. We've talked a lot about investors, and I've got a couple of friends that have been CFOs, and one of the things that they have strongly suggested, if you're going down the investor route, don't delay in getting the investor type of MI and board packs.
Yeah.
And I think the rationale that they have come up with, get 80% of it now, you can finesse the last 20% with your new shareholders. If you found that your MI pack's not there and it's now included as one of the 100-day action plan items, you've created yourself a lot of pressure.
I think that's a good point. Very good point. It's that familiarity and that assurance and comfort factor that this is a business run in a familiar way to how our portfolio companies work, and therefore there's a good fit from a governance point of view, and possibly cultural as well.
It just comes back to what I said in the strategic. It just helps that transaction. So if you know you go down that way, get it done, do it soon.
One question you mentioned, investors and their MI. I mean, I'm sure we're all familiar with some investors, particularly the private equity industry, where they are data hungry and MI hungry. But for SMEs and high growth businesses more generally, David, I mean, how would you get the balance right between doing enough and doing everything and it taking a disproportionate amount of time, perhaps limiting your scope to be commercial and strategic?
It's a real tricky area of getting this the balance right. I think a lot of it, I would say, is you're looking at how the business is going to go and evolve 12, 18, 24 months.
Yeah.
And really it's looking at your forward runway and really using that to assess where you need to be. Is the decision making going to be more complex as you're looking into the future? If you're taking on new funding instruments, you're taking on new liabilities, your contract sizes are getting bigger. Those types of areas where you're increasing the scale dramatically of the business, I think you're better doing this sooner rather than later. And it may be a case of, you know, where you want to get the business, but you're going on increasingly from a lighter touch to a heavier touch as you're going through that period of time. So you're not doing it all at once. You might be having a 6, 9, 12-month transition, but what you've got a clear runway where you want to be at in a set period of time.
Okay. Right. Thank you, David. Shall we go on to cash flow, business oxygen, as I've heard it called recently?
Yeah, because without it, the company will die. And picking up the main points from the slide, and also the points that David was making in the MI section, that to look at the very obvious downsides of it, the destruction of confidence and the value of the company, cash does that, leading to insolvency. So that's the end of the dream. And and startups and entrepreneurs, it's not just about the company, it's about hopes and dreams and everything that you put into it. So if it's not insolvency, therefore keeping the company running at any cost, that could be a very costly fundraising, and which could involve avoidable and unnecessary equity dilution, and it becomes very time consuming and stressful, and also stressful post that of dealing with a costly fundraising. So the way out of this is planning, and the basis of that planning is good MI. There's no use constructing a forecast on very shaky foundations, because that's either going to miscalculate your runway, so you're out of cash before you expected to, or you plan some growth hypotheses based on faulty analysis. So the bedrock of the forecast is the management information, and knowing that your historicals are pretty good. They don't have to be to the penny, but they need to be as good a reflection of what's happening in the business as you can, and accurate enough for you to say, right, now we can use these to basically predict our understanding of our own business environment. So it's the best guess of the founders, those involved, of what their business environment is going to look like in the next 12 months, and the cash that's going to be involved in actually getting to the other side of that. So for example, taking companies which are, say, like SaaS or software tech startups, an awful lot of cash goes in the R&D projects on that.
Yeah.
And, I think really strong controls need to be put around those projects, and with budgets and monitoring them, and also not forgetting that the overheads require attention too, because in both sides, there are many sides of the VCFO. One side is the guardian of the cash, the guy who, or the person who makes every penny a prisoner, because keeping control of the overheads therefore allows and frees up the cash for growth, because growth is a hungry beast, and it will devour cash. So, and that's what you're trying to grow the engine, as we said. So that is a key thing, the tightness on the discretionary spend. Also, the clarity in working capital cycle, 3 and 4 together, is your VCFO, your CFO in time is the person that you want to have an understanding of the integrated business, i.e. the cycle. If you're, for example, buying in stock or buying in components, which you then assemble, maybe you put software on top of that, whatever. But from the point that you're buying in that stock and paying for it to the time you either assemble it, get the order, get it out the door, and then get the money in, is that cycle of the cash going through the business and actually having the KPIs, to come back to David's point, about, you know, how long is that taking? How long is it take? For example, at Waterson's, one of the things that we had a big objective over the years was to have negative working capital. That means basically we were turning over the books, we were selling the books quicker than the time we took to pay the publishers. So in effect, we were getting the cash in, because obviously you go into a store, buy a book, you hand over the cash straight away. So we would get the cash in and then pay the publishers. So that was the game that we, not the game, that really was the business objective that we set ourselves, and we eventually got there. Yeah, and you know, it really felt good that we got the engine humming to that extent. So coming to the other points of planning the perfect storm, well, I don't think anybody would have thought of COVID as a perfect storm, but certainly, as we know, since COVID hit, a lot of our work in Ignition Financial has been helping reforecast, draw up new plans, because it's a new business environment.
Yeah.
And I think it's really important when businesses are preparing their cash flow forecasts that they don't try and game it with investors. They don't try and lowball it, but they don't want to be too aggressive. So I think I would advise that the companies give it the very best guess of what they think their business environment is going to throw up in the next 12 months and how they're going to deal with it, how much cash it's going to take, how many heads it's going to take, what sort of discretionary spend it's going to take. Then on top of that, you can begin to lay the scenarios. So what happens if our sales are 50%, 75% of what we forecasted in our base? And I don't mean base as in low, I mean base as in our best guess at what our normalized scenario would look like. And then you can also lay on the cost side, okay, if we defer those tech hires, what does that do to the build? If we defer those sales support staff, what does that do to the sort of, you know, customer experience, etc. So there's all of that scenario planning around the base. And in addition to that, the founders, the VCFO, the CFO in time, always wants to have in their back pocket that pot of money that they know that they can cut in an emergency. It might be the difference of 1 month's runway. And in these times where fundraising may take that little bit longer, the cash is out there. Again, the investors maybe just wanting to have a little bit more assurance about the viability and risk of a business. I think that difference in just having that headroom of an extra month's runway, it, could be critical. And therefore, because of that potentially extended raise period, that businesses should be looking to start the next round of funding probably a little bit earlier than they would otherwise have done. So again, it's planning, it's honing your forecast up against the reality of your business environment, and really trying to make sure that, months 1, 2, and 3, or in David's scenario of a 13-week forecast, weeks 1, 2, and 3 are really accurate. You can reforecast the 11, 12, and 13 weeks, or months 9, 10, 11, 12, or in the case of a 5-year plan, the hockey stick years of years 4 and 5, because you'll be doing umpteen more forecasts before you get to those. But it's really critical that you get the near weeks, the near months, the near years, as spot on as you can. That's where credibility gets built from.
I think you've made a number of really, really important points, and the one which does stand out is that it is, we are hearing, taking a bit longer to access venture capital funding at Series A, Series B level, and that's for very apparent reasons. It's venture capitalists do want to meet face to face before they write out a check to people. So we used to, we would commonly advise clients, look, allow 3 to 6 months from first contact to actually closing money in the bank, an investment round. And I think it's sensible now to be planning towards that 6-month end, if not longer. So this, I cannot emphasize enough the cash flow forecasting and looking ahead out as certainly 13 weeks, but as far as you can to make decisions about, right, we need to start having conversations now about our Series A, Series B round, because it will come quickly around the corner and is taking slightly longer than it was pre-COVID.
I was just going to like to go and just take go a little bit higher up that. And Tom, when you're talking about the R&D stage, and a lot of companies have got to spend a lot of cash on development, an area I've seen that's becoming more and more popular is using a lot more stage gating. So, for example, you've got £1 million for your development program. You're making sure you've got stage gates through that you're agreeing to commitments for smaller chunks. You're wanting to see evidence that you're going to go and get to where you need to, and then you're authorizing the next level of expenditure. And in that way, you have got that flexibility of going slower or possibly even pushing things to the right if you're not getting the traction you want, rather than effectively signing off to that big commitment up front. And it can certainly make a material difference to your cash flow.
Yeah, I would really thoroughly agree with that, David, in the sense that you don't want to be the corporate ogre, but in that situation, you are basically saying to your internal colleagues, whether you're in terms of VCFO support and advising and guiding, is to say to them, you have to come to me, the CFO, and prove your next stage of release of funds. So it's not a given, because we can just turn the taps off at any time if we feel it's not working. And we've seen this with clients who have done big investments, but at least have had the information and the courage to turn it off and just say, we don't believe, the market appetite for this is what it was. Therefore, we've spent this money. I know what we're turning the taps off now. So I think there is that proving that they're worth the scarcest of resources, in a growth cycle, is the cash.
Okay. Right. I think we should probably, in the interest of time, move on to the final topic, which is accelerating growth. Most of certainly the companies and the entrepreneurs in our community are growth and hyper growth companies. David, what are the things here that we should be thinking about?
Well, I'll cover three headings. What some definitions and why you want to accelerate and why you want to grow. I'd also go why does it frequently keep many people awake at night? And then, importantly, how your CFO can help through this process. This is a huge topic, and I'm going to skim the surface. So just moving to the first one of growth. And in a business context, growth is about improving the measures within an enterprise. It's frequently referred to a sales, revenue, profit, capital value, or marketing footprint on the marketing side. So it's very much about making something bigger. The acceleration is you're wanting to get there faster and quicker. Mm-hmm. So going back to growth, why do businesses want to do it? And I suppose the first one I always think about, it's really hard work to stand still. And if you're not growing, you're going backwards.
Mhm.
So evolution, you need to go forwards, and that's growth. Two main drivers of it are either your founders, or if you've got external stakeholders and institutions, it's a stakeholder decision on the rates of growth to be pursued. So go on then to the acceleration. Primarily, the reasons why you want to go faster is market opportunity, there's footprint, you're able to get some big strategic angles. You saw that many years ago with the with some of the telecom companies and the mobile phones. They were desperate to get customers. You saw it with the internet as well, with various evolutions of business models. It's all about getting the customer. The other aspect is in financial returns. It can be very beneficial to get there quicker, be it in a discounted cash flow basis, or be it in absolute cash, insofar as by getting there quicker, you're not incurring as much money on your overheads of the business.
I noticed you've got first movers advantage there. I know that this comes up a lot and is debated. Certainly with technology companies, it's been it's more, well, technology, any innovative company, rather than first mover advantage, it's some of them say it's fastest mover wins.
Yeah.
So someone, you know, there are a number of case studies of businesses which have just raised crazy amounts of money. They've grown quicker and they've got the destination a bit quicker. There are also stories where they've raised a lot of money and burnt a lot of money and not got very far, but yeah.
But it's ultimately for domination, isn't it now?
Yeah, it's land grabs and market share, and yeah, it's certainly the Silicon Valley model.
So that's why there's some of the reasons for the growth and why you want to accelerate it. So why does this great opportunity frequently challenge you and keep you awake at night? I suppose the first two are very apparent. The first one is we haven't got enough money. Do we have enough money to get there? And the second one is the time element of it. It's just taking longer. It's more difficult than potentially we expected. Have we underestimated the amount of time? The next areas are at a strategic level. You've got your strategies for growth, but have you aligned your capabilities up within the business? Have you got a business that's able to go and deliver those strategic objectives? Have you worked out your sequencing and your decisions correct for going through your hires, putting the key building blocks in place? Another common area for, I suppose, some sleepless nights about this is as businesses grow, their teams need to evolve. You may need more specialists, and finding specialists, the right person, they can be a real scarce resource. So do you have the right team? Do you know do you know what you need, when you need it, and ideally who you need to go and get? So potential challenges of getting the right team to evolve with you. And then probably the last one is going back to the MI element is, do you have the right milestones and signposts that you're making the progress that you need to on this journey? I'll say there's really 5 very common reasons that as founders and CEOs, that sort of the growth agenda causes some sleepless nights. So we then end up with how the CFO can help. And I suppose there are 2 really critical elements to this. The first one is the CFO needs to be on top of the MI, and there needs to be real confidence in the cash runway.
Mm-hmm.
You've got those 2 boxes ticked. You can then focus on the CFO being a partner to the business. They're involved in the evolution, in the driving the business forward. They're there potentially, possibly for mentors, they're assisting some of the senior people within the business with some of the challenges under their area. Leadership is also a very important one. The CFOs should be, and it's very useful to them to be visible. So them having the inspiration and really encouraging people is an area that can help no end. And then I suppose it's coming back to that fifth point, is about the KPIs and the milestones, having a really good set of milestones that people can see and understand and can go and take corrective action as they're going through this growth agenda.
Okay.
So there's sort of 5 or 6 areas where I think it's particularly useful to for the CFO to be involved in the growth agenda and the scaling up. Yeah,
and I think a number of times from when I've been involved with high growth businesses, it's really about the time to partner the business. It's helping the founders and helping them look great in front of their investors, giving them the confidence that yes, that here's the data to support this decision, and yes, what will that, if we take that particular decision or make that investment in those new hires or in marketing, then what does the MI and the data say will happen? And I think that is quite reassuring, and it is greatly appreciated in what can be a very, very lonely place as a founder or a co-founder for that matter. Perhaps we could move on to some Q&A now. So if you do have any questions, please do put them in the Q&A box. So we've had one from Toby. So say, what's in it for the VCFOs? How do David and Tom pick the businesses that they want to help, and how do they stick with industries that are familiar? Tom, is this?
How do we pick them? I'm not sure that we necessarily just go around saying, well, I'll have that one, etc. But one thing I mentioned at the beginning in what is a VCFO, and I was talking about the experience of a VCFO in terms of battlefield medicine. And I think, a lot of chartered accountants get this because they start off in audit in big practice, and that is company to company, sector to sector. There's some specialization, but that is really the idea of battlefield medicine. And therefore, as you go through your career, you're working in different sectors. Some will have their particular requirements, but often, say, financial services accepted, it's distilled into sort of key financial practices. So I think that is really the value that a VCFO can bring. And obviously, working within Ignition Financial, it's predominantly focused on startups and scale-ups. So we are in that environment all the time, bringing sort of that experience of 30 odd years. Okay, it's in bricks and mortar, obviously some of it, but the more that I've been working with Ignition Financial for 4 years now. And that's a reasonable amount of battlefield medicine. So I think you do see a certain commonality of issues as companies begin to grow, and I think that's where we can add the value.
Glyn has asked what sort of costs are involved in taking on a VCFO. I'll open this up in a minute. I suppose what I think what Tom and David have alluded to is that this is quite a bespoke approach. So certainly the approach that we take at Ignition Financial is we scope out what the needs are of the client. In some instances, it's just a project, and we will try and define what the project may be. So helping a business get ready for Series A investment and to help them get through the due diligence of a venture capital or PE firm, in which case that's a fixed, that's a project. And if we can't do a fixed fee, we'll at least try and give an estimated range. Where more recurring support is involved, then the cost will be a fraction of what you would expect to have a full-time CFO. And generally that's because this is aimed at businesses who don't need to hire a full-time CFO. They may have a management accountant in place, they may even have a financial controller in place. But this is about getting value for money. And so it may be that actually 2 or 3 touch points a month, or maybe 1 touch point a week is all that is required for a CFO, and therefore you don't need to go and take out a big hire a 6-figure CFO salaried person. I think that similar question was also asked by Ian, so hopefully that covers both of. Although Ian did also ask about is it cash and equity, and I think there's a mixture throughout the market. The same approach applies. Is you would use equity to align incentives where you think you found a key person and you want them on your journey for and until that exit, I suppose. David, Tom, anything?
Yeah, I mean, in terms of how much does it cost and what sort of engagements do you have? I mean, currently I range from attending board meetings, so patching in, through the financials, listening to and being part of the sort of funding discussion, say, and attending the clients' ops meetings every week on that. So very involved from that point of view. To the other side of, I spend 1 hour per month mentoring and coaching a young CFO who's doesn't reside in this country. They don't have a UK base. They're based out of Brussels, and they have African and Eastern Asian logistics operations. So it's as and I spend maybe an hour reviewing the accounts and then talking through it, and what does he think of it, and where does he see the issues and that sort of thing. So it's as and probably everywhere in between. So it's quite it's diverse. There's no particular template. It really depends on where the company is in the cycle, what they're looking for from the services, what sort of advice, and ultimately as well, what sort of budget they have too, because everything has a budget. Everything should have a budget.
They should have a budget.
VCFO services budget as well.
Their speaker for CFO. There we go.
What I'd like to just add on that one
Sure.
is also, I look at it, but it's very dynamic. You may end up with a low level of touch points for a couple of months, and then you may end up with some specific projects which are critical. You want some more support on those.
Yeah.
So you may end up with a real ramp up for a couple of months on some activities. They come to a natural conclusion, then you go back to the lower state. So flexibility and dynamism is really important.
Exactly. Yeah, I think that's a very, very good point to make, actually, David. Thank you. I think we've got time for a couple more questions. Alan has asked, is there a stage where it's simply too early to bring in a VCFO, for cost and complexity, perhaps? I have a view on this, but let's hear from David. Why don't you go first?
You're raising money. There's equity involved. That sounds at least the earliest, no later than that point. So having someone independent, the CFO, to go and help you through that process, for me, is probably a starting point. So that's certainly before your first raise. So you could say that's really almost on day one.
Tom?
Yeah, I think there's no earliest point. I often have looked at situations and spoken to the CEO and the founders, and it's been a little bit late. Models and numbers have gone out to potential investors, which really should not have gone out. And so it's actually saying it doesn't have to involve a lot of time necessarily, but it's just saying, look, can we have someone who's seen many of these before go over these and then, come back to us with a list of questions, and so that you can sense check them and have a conversation. Now, that could be a couple of days' time, but that couple of days' time could really save, weeks of to and fro, or, a cooling or disengagement for investors, or, as David said, a more punitive deal, being sort of minimized, just from the engagement early. It's not a fear thing, but it's actually just trying to get the quality of the process improved from the point of view of the founders.
Mm-hmm. I think if I were to think, I work with quite a lot of technology companies myself, so to put it into common language, it's often driven by the investors and what the investors want and need, and I think pre-seed and seed rounds, some of those investors may be okay with not having a formal engagement with a CFO for, say, who's involved in maybe once or twice a month, but certainly getting to that late seed stage where you're approaching Series A, it is worth getting somebody involved who can help you get ready. It will make a difference, because sure as night turns today, the venture capitalists are going to want to have some senior financial strategic support in the business. And if you can have someone of your choosing that you get on with and the chemistry is right before that raise, then I think, and it seems to be the case from the results, that your probability of closing a Series A, your valuation is going to be better, rather than having somebody, forced upon you, perhaps. Okay, I think we'll take one more question and then we will wrap things up. Ian has asked the question: do we have relationships with particular investors, or are you completely independent? Tom?
Relationships, we know investors, we can, as Adam, this is probably more your area, we can facilitate introductions to.
Yeah.
We don't work on behalf of any investors. We've been, completely independent since we started, and will continue to be so. And therefore, as I said right at the beginning, the VCFO, can be that sounding board, because there is an objectivity there, and it's not only an objectivity you would expect from someone, of professional standing and institute and all that sort of stuff, but it's also an objectivity, from the firm as well. So the answer to that is we're not connected to anybody.
Correct.
Tom, at the very start, you used a word that I think is really important, and that's the trusted advisor.
Yeah,
and
our engagements are with the company, so we take instruction from the board, and usually that is led by the founders. So when investors come on, sometimes they are on boards as well, but everyone is working together at that point. We are not, typically our referrals come from the entrepreneurs themselves. We do have some investors who recommend us, but not as many as, I would say, traditional accountancy practices. So I don't think we are ever brought in as the venture capitalist guy to come in and sit in the company. It's more often than not we're coming in to work and support the entrepreneurs, and help make that relationship with both prospective investors, but in particular investors already on board, as smooth as possible. Okay. Look, I think we'll call it there. David, Tom, thank you so much for giving your time and your insights. Very much enjoyed it. Thank you to you all for tuning in. And if you'd like any further information, or if you'd like to speak with David or Tom, then details will be included in the follow-up email. I'm sure they'd be delighted to chat with you. Thanks very much, and have a lovely weekend when it arrives.
Thank you.
Goodbye, everyone.
Cheers.